Welcome to the Deep Dive. Today we're pulling back the curtain on a company that, well, you might not see its logo everywhere, but it's absolutely foundational to the digital world we live in.
Mm-hmm.
We're talking about Taiwan Semiconductor Manufacturing Company, or TSMC.
Right.
This deep dive is really our mission to unpack TSMC's unique business model, its competitive strengths, leadership, financial health, and, the crucial risks and opportunities that truly define its future. It's a story of, quiet dominance.
And for this deep dive, we've drawn from sources that offer what we call an enduring business quality analysis.
Okay.
Essentially, we're looking at TSMC through a lens that asks, is this a business built to thrive for decades?
Right.
Our goal is to extract those vital nuggets of insight about what makes TSMC such a resilient and dominant force, and crucially, why its operations and strategic decisions profoundly impact you, whether you're simply curious about tech, watching global markets, or, building the next big thing.
Okay, let's unpack this. To truly understand TSMC, I think we have to start with its unique business model. What exactly does pure play foundry mean? And why is that such a game changer for their success?
It's brilliantly simple at its core. TSMC basically pioneered this model back in 1987.
Mm-hmm.
They manufacture semiconductor wafers entirely based on designs provided by their clients. Think of them as the ultimate specialist factory.
Okay.
They offer a full suite of services: design support, mask making, the actual wafer production, packaging, testing, the whole lot.
Right.
But here's the crucial part of pure play. Their company charter explicitly prevents them from ever designing, branding, or selling their own chips.
Oh, interesting.
Yeah. They are, by design, a partner to innovation, never, ever a competitor.
So who are these partners then? Give us some examples of the titans of tech who are relying on TSMC for their most cutting-edge products.
Oh, the client list reads like a who's who of global tech. You've got the fabulous companies, think Nvidia, Qualcomm, AMD, who focus purely on chip design.
The big names.
Exactly. Then there are integrated device manufacturers, IDMs like Intel, who have their own factories, but strategically outsource some of their most advanced production to TSMC.
Right, even Intel.
Even Intel. And perhaps most notably, systems companies like Apple. Apple actually accounted for roughly 25% of TSMC's total revenue in 2023.
Wow, a quarter of their business just from Apple.
Yep. This partner, not competitor model is built for decades, precisely because of the staggering costs and complexity involved. Building a modern fab, it can cost upwards of $20 billion.
$20 billion. That's not exactly a weekend DIY project, is it?
Not quite. It forces specialization. Innovators focus on design, and TSMC focuses on flawless manufacturing.
So if they're building these incredibly expensive, complex factories, what do you see as the true bedrock of TSMC's long-term endurance? How much of that really comes down to trust, and maybe what else is at play?
Trust is absolutely foundational. I mean, for a fabless company, their chip design is their crown jewel, right? Their most valuable intellectual property. Entrusting that IP to a manufacturer who is also a direct competitor, like, say, Samsung, creates an inherent conflict of interest. It's risky.
Yeah, I can see that.
TSMC's Pure Play Charter is basically a structural guarantee. It eliminates this conflict entirely.
Okay.
This doesn't just build trust, it fosters these really profound, lasting collaborations and creates incredibly high switching costs for their customers.
High switching costs.
Yeah.
Meaning it's hard for customers to leave.
Exactly. Imagine Apple or Nvidia moving all their production to a new foundry. The risk, the retooling, the trust building from scratch, it's just immense. That structural guarantee is kind of a genius move that makes them almost indispensable.
That brings us perfectly to TSMC's economic moat.
Ooh.
How exactly do they protect this competitive fortress they've built?
Well, their moat is incredibly wide and deep. It stems from this powerful, sort of self-perpetuating feedback loop between two primary sources: intangible assets and cost advantages.
Okay, let's break that down. Intangible assets first.
Right. On the intangible assets side, we're talking about undisputed technological leadership. TSMC is consistently the first to commercialize the most advanced manufacturing nodes. Think 7mm, 5mm, and now 3mm.
And why does TSMC being first to 3mm matter to you, the listener?
Well, because it means the next device you buy, whether it's an AI-powered smartphone or maybe a new gaming console, it'll likely be faster, more efficient, and more powerful precisely because of TSMC's bleeding-edge capabilities.
Got it.
This lead is protected by proprietary techniques, thousands of patents, nearly 3,000 just for advanced packaging alone, and decades of accumulated tacit knowledge. The stuff you can't just write down easily.
Right, the know-how.
Exactly. A great example is their CoWS packaging technology.
CoWS?
Yeah, CoWS. Think of it like building a super efficient high-rise apartment for chips, stacking them vertically instead of spreading them out.
Oh.
This allows for much faster communication between them, which is absolutely critical for today's high-performance AI processors.
Okay, and what about the cost advantages side of the moat?
That comes from their unmatched manufacturing scale and, crucially, superior operational execution. They operate the world's largest fabs at immense volumes.
Economies of scale.
Precisely, leading to significant economies of scale and a lower cost per transistor. But, I think most critically, their consistently higher manufacturing yield.
Yield meaning?
Meaning the percentage of functional working chips they get from each silicon wafer. Their higher yield provides a direct and massive cost advantage for their customers. More working chips per dollar spent. It's huge.
Can you give us a real-world example of this moat in action? How does this play out with actual customers?
Yeah, absolutely. We've seen a very clear pattern of customers moving from competitor Samsung over to TSMC.
Oh, really?
Apple famously moved its A-series iPhone processor production years ago. That wasn't just to avoid sharing IP with a direct smartphone rival, but crucially because TSMC's tech was just better.
Better performance.
Better performance, better power efficiency. More recently, both Google for its custom Tensor processors.
In the Pixel phones.
Exactly. And Qualcomm, for its flagship Snapdragon chips, have reportedly shifted high-end production to TSMC. These decisions were driven by TSMC's superior performance, power efficiency, and especially those critical manufacturing yields we talked about.
Mm-hmm.
It really proves that even a giant like Samsung can't quite match TSMC at the leading edge right now.
So given all this, is their moat just holding steady, or is it actually getting wider?
The evidence strongly suggests it's widening. If you look at the global pure-play Foundry market share data, TSMC's share actually increased from about 62% in Q2 2024 to over 67% in Q4 2024.
Wow, that's a big jump in 6 months.
It is. And over that exact same period, Samsung's share actually eroded from about 11.5% down to 8.1%.
Ouch.
Yeah, that divergence is pretty clear quantitative proof. And at the real technological frontier for sub-7 nanometer process technology, TSMC is estimated to control over 90% of the market.
90%.
It's basically solidifying a quasi-monopoly at the high end.
Okay, so beyond the impressive numbers and these strategic moves, what's the word on the street? What are customers truly saying about TSMC?
Well, individual testimonials are obviously private, but TSMC itself reports a 94% customer trust and satisfaction rate in 2023.
Pretty high.
Very high. It reflects their whole virtual fab philosophy, aiming for seamless integration with their partners. But honestly, the most compelling evidence is simply what companies do.
Actions speak louder than words.
Exactly. Apple, Nvidia, AMD. Yeah. They entrust their entire product roadmaps and billions of dollars in R&D to TSMC's execution. A Bain & Co. analyst put it perfectly, saying, TSMC is just absolutely critical. They're a near monopoly at the bleeding edge.
Yeah.
And CEO C.C. Wei himself constantly reinforces this. It is a trust business. We do not compete with our customers. Their actions consistently back that up.
That a powerful vote of confidence from customers.
Yeah.
But what about the employee perspective, especially as TSMC embarks on this ambitious global expansion, building factories outside Taiwan? Are there any friction points emerging there?
That's a really important question. TSMC's stated culture is built on pillars like integrity, commitment, innovation, customer trust. ICIC, they call it. And they aim for a dynamic and fun work environment.
Sounds good on paper.
Right. However, reports coming out of their new Arizona facilities paint a somewhat different picture. There are citations of a brutal corporate culture with standard 12-hour days and common weekend work.
Ooh.
Yeah. There are allegations of a significant culture clash between the Taiwanese and American work styles. Claims that the company isn't quite ready for America, that non-Taiwanese employees face challenges, and maybe that key assignments are preferentially given to Taiwanese expatriates.
That's a stark contrast to their stated values. I imagine managing that kind of cultural friction, especially across continents, that must be an incredibly delicate balancing act for leadership. And it could pose a tangible long-term execution risk, couldn't it?
It absolutely does. Look, diversifying manufacturing outside, the plants in the U.S., Japan, it's paramount for mitigating geopolitical risk. Everyone agrees on that. But leading-edge chip manufacturing demands a highly skilled, stable, and motivated workforce to maintain TSMC's punishingly high standards of quality and yield.
You can't afford slip-ups.
Exactly. If this reported cultural friction hampers their ability to attract and retain top-tier talent in these new locations, it could potentially lead to lower yield, project delays, higher costs, basically undermining the whole purpose of their diversification strategy. It's definitely a critical challenge to watch.
Okay, let's pivot now to how TSMC's leadership and financial strength contribute to its enduring quality. How has management demonstrated a long-term owner's mindset, looking beyond just the next quarter's results?
Well, the leadership provides remarkable continuity and a really consistent philosophy. CEO C.C. Wei, who's been at the helm since 2018 and also became chairman in June 2024.
So he holds both top spots now.
Right. He consistently emphasizes technology leadership as the core strategy, always saying it's supported by strong demand for their industry-leading technologies. Their capital allocation is very clearly demand-driven, purely to support customer growth.
Makes sense.
And despite the immense costs of building these new fabs, they remain committed to a long-term gross margin target of 53% and higher. That shows a clear focus on profitable growth, not just growth at any cost.
Right.
And crucially, they have an explicit shareholder focus, consistently committing to a sustainable and steadily increased cash dividend.
Okay, so with all that cash flow they generate, how do they actually deploy it? What's their capital allocation track record look like in practice?
It's really a masterclass in moat widening. Reinvestment in the core business is clearly their highest return use of capital. You see it in the numbers.
How so?
Their capital expenditures, CAPEX, are just surging. It went from about $18 billion in 2020 to a planned $38 billion to $42 billion in 2025.
Huge numbers.
Massive. And a huge chunk of that, 70% to 80%, goes directly into advanced process technologies. That acts as both a strategic weapon and an immense capital barrier to entry for any potential competitor.
Building the moat higher.
Exactly. Research and development spending is also rising steadily, accounting for 8 to 8.5% of revenue in 2023, up from 7.2% the year before. That's direct investment in those intangible assets, that tech lead.
Mm-hmm.
They're also highly disciplined with acquisitions. Their growth is almost entirely organic, which means they avoid a lot of the risks that come with big M&A deals.
Smart.
And for shareholder returns, as I mentioned, they have that stated policy to maintain a sustainable and steadily increasing cash dividend. They've paid one every single year since 2004 without ever reducing it.
Wow, never reduced it.
Never. In 2024, they paid out $11.3 billion in dividends, which is a 24.5% increase from the prior year. So they're serious about returning cash, too.
These strategic moves certainly sound impressive. But does that excellence truly translate into, robust financials? How strong is their balance sheet, really?
Oh, absolutely. TSMC is truly a remarkably consistent earnings machine. I mean, consider this. In an industry known for its brutal boom and bust cycles.
Very cyclical, yeah.
TSMC has compounded revenue and earnings at over 16% annually for 3 decades, since its listing in 1994.
That's astonishing. For that long in semiconductors.
It really is. It suggests they're playing by a different set of rules than their peers somehow. Even in the semiconductor downturn of 2023, they remained exceptionally profitable, posted a 54.4% gross margin, and a 42.6% operating margin.
Still making tons of money in a downturn.
Exactly. And as the market recovered in 2024, profitability expanded even further. 56.1% gross margin, 45.7% operating margin, and net income surged by almost 40%.
Wow.
That just showcases immense pricing power and operating leverage.
Are there any specific, quality ratios that really confirm this business strength for our listeners? Something they can look at?
Yeah, definitely. If we look at their return on invested capital, ROIC, it has consistently been in the mid to high 20s. The average over the last 5 years is 24%.
Which is good for this kind of business.
It's world-class for any business, frankly, but especially one as capital-intensive as semiconductor manufacturing. It demonstrates that their massive reinvestment projects are highly value accretive. They're building smart, not just big.
Okay.
Their free cash flow conversion. Now, this is depressed a bit by the current massive CAPEX cycle.
Because they're spending so much.
Right. But it still hit 75.1% in 2024. That means for every dollar of accounting profit they earn, a significant chunk still makes it to the bank as actual cash.
That's healthy.
Very healthy. And finally, their balance sheet. It's an impenetrable fortress, basically. They actually hold more cash than total debt.
Negative net debt.
Exactly. A truly rare position for a company of this scale. Imagine a company so financially secure it could pay off all its liabilities tomorrow and still have billions left over.
Yeah.
That gives them an incredible financial safety net and tons of strategic flexibility.
So, okay, we've established it's an exceptionally strong company. Top-tier tech, great management, fortress balance sheet. Now let's turn to the investment proposition. What's the current price of such a quality company, and what does that tell us?
Right, the valuation. As of mid-2025, TSMC's valuation multiples definitely reflect the market's clear recognition of its quality. Its price-to-earnings ratio, the PE, sits around 27 to 30 times earnings.
And how does that compare historically?
That's a premium to its 5-year historical average, which was more like 22 to 25 times earnings.
Okay.
And the price-to-free cash flow ratio is even higher, around 39 times. But again, that's largely a direct consequence of that aggressive CAPEX cycle temporarily suppressing free cash flow relative to accounting earnings.
Got it. So the critical question then, is the market's current valuation of this company actually fair for a long-term investor? Is it too expensive?
That's the million-dollar question, isn't it? Or maybe the billion-dollar question here. At current levels, the valuation is demanding, let's be clear. But I believe it's likely fair for an investor with a multi-decade time horizon.
Fair, but not cheap.
Exactly. It's certainly not a bargain bin find. But the premium appears justified by two critical factors that have really emerged over the last, say, 24 to 36 months.
Okay, what are they?
First, the advent of the artificial intelligence supercycle. This has fundamentally accelerated TSMC's addressable market and its whole growth profile. This structural shift just wasn't fully reflected in prior valuations.
Right, AI changes the game.
It really does. Second, as we discussed earlier, TSMC's competitive moat has visibly widened. We see that with those key customer wins from Samsung. So essentially you're paying a higher multiple today, but arguably for a business with a demonstrably stronger competitive position and a much larger, faster growing end market thanks to AI.
So maybe a reasonable entry point.
I think you could argue it represents a reasonable entry point to own a share of a truly exceptional, maybe even unique company.
What then is the primary growth engine for TSMC's future earnings? Where's the big tailwind coming from that justifies that valuation?
Yeah. The single most important driver looking forward is the structural multi-decade demand for high-performance computing, or HPC, chips.
HPC.
Right. These are the chips that form the backbone of the whole artificial intelligence revolution.
Okay.
HTC has already actually surpassed smartphones to become TSMC's largest business segment. It made up 51% of their revenue in 2024.
Over half their business now.
Yep. And management has explicitly identified it as the strongest driver of TSMC's long-term growth.
Makes sense.
The entire AI ecosystem, from training these massive models in data centers to running AI efficiently on your devices, it all relies on TSMC's cutting-edge chips. They're truly like the toll road on the highway to an AI-powered future.
That's a good analogy.
And the overall semiconductor market itself is projected to become a $1 trillion industry by 2030, fueled primarily by AI, data centers, and automotive applications. TSMC is right at the center of that.
Okay, but every great company has risks. What are the potential permanent impairment risks TSMC faces? The things that could really derail this impressive trajectory.
Absolutely, there are significant risks. There are three main ones we should probably focus on.
Okay.
The first, and arguably the biggest elephant in the room, is geopolitical conflict.
Taiwan.
Exactly. Its heavy concentration of advanced manufacturing, the really cutting-edge stuff in Taiwan, is its single greatest vulnerability. A conflict there would be, catastrophic for global supply chains and obviously for TSMC itself.
Right.
Now, they're actively diversifying their footprint building in the U.S., Japan, Germany.
We talked about the Arizona plant.
Right. But it will take years, maybe many years, to significantly reduce that concentration risk. So it remains a low probability, but exceptionally high impact tail risk. You can't ignore it.
Definitely not. What are the other big risks?
The second major risk is a technological misstep or a competitive resurgence. Despite TSMC's formidable lead right now, it's not guaranteed forever. Technology moves fast.
Sure does.
There's a persistent risk that a competitor, most likely a revitalized Intel, especially now that it's backed by substantial U.S. CAPEX Act subsidies, could achieve a breakthrough, close that performance and yield gap.
And if that happens?
Well, if a viable, good enough alternative emerges, especially for some customers, it could seriously erode TSMC's pricing power and its market share. That's a big threat.
Okay, and the third risk?
But the third one is customer concentration and power. As we mentioned, TSMC is highly dependent on a small number of very large customers. Apple and Nvidia alone were, 25% and 11% of revenue, respectively, in 2023?
That's over a third from just 2 companies.
Yeah. If a key customer like that faces its own challenges, or maybe strategically decides to dual-source manufacturing with a competitor like Intel, maybe just to de-risk its own supply chain.
Spread the risk.
Right. The impact on TSMC's revenue, and importantly, its fab utilization rates, would be significant. Empty factory space is very expensive.
Okay, that makes sense. So let's finish with some second-level thinking. What might the market be missing or perhaps misinterpreting about TSMC? Where's the potential edge for an investor?
Okay, yeah, good question. The prevailing market consensus, I think, accurately sees TSMC as the tech leader, the key AI enabler. But it discounts the stock pretty heavily because of that extreme geopolitical risk in Taiwan we just discussed.
Right.
The stock's valuation is often seen as this kind of tug of war between those two powerful forces. Amazing business, scary location.
Okay, so it's the contrarian view.
Well, a contrarian view might suggest the market could actually be underappreciating the true durability of TSMC's economic moat.
How so?
It's not just a temporary technology gap, right? It's this complex self-reinforcing system. You've got the trust from the pure play model, the proprietary process knowledge, the superior execution, those unmatched yields we talked about, and just the immense scale that creates this constantly growing capital barrier.
It all works together.
Exactly. And those recent customer wins from Samsung, where even giants like Google and Qualcomm are switching their high-end stuff. That strongly suggests this moat is still actively widening, not just holding steady. Which might mean the probability of a competitor, even Intel, breaking this virtuous feedback loop in the next, say, 5 to 10 years could actually be lower than the current valuation discount implies.
That's a truly fascinating nuance. So the moat might be even stronger than people think.
Possibly. And furthermore, and this is where it gets really interesting, I think, while that geopolitical risk is the primary reason for the stock's valuation discount, it also paradoxically contributes to the moat in a weird way.
How does risk contribute to the moat?
Well, think about it. The world's immense reliance on TSMC's concentrated capacity in Taiwan implicitly encourages governments, the US, Europe, Japan, to actively support TSMC's stability and technological leadership, even while they're also pushing for diversification.
So the risk itself makes TSMC strategically important.
You could argue that. In a more nuanced view, the risk itself is actually what creates the opportunity to purchase this maybe unparalleled business at a price that's fair, rather than astronomically expensive. The market often sees the risk as just a simple negative, right?
Yeah.
But for a long-term investor, maybe it's part of what makes this whole investment opportunity possible in the first place.
What a deep dive. So we've uncovered TSMC as this quasi-monopoly on a truly critical global resource, armed with a self-reinforcing economic moat, rational and disciplined management, and riding this huge structural growth wave from the AI supercycle. It's clearly a powerhouse navigating a very complex world.
Absolutely. And maybe here's a provocative thought for you, the listener, to consider as we wrap up. The greatest risk to TSMC, and maybe to an investor, might not actually be a direct geopolitical conflict, as scary as that is.
Okay.
Instead, imagine a perfect storm scenario. Imagine the AI supercycle proves to be more of a cyclical bubble than a smooth, decades-long secular trend. Maybe there's a sharp downturn in demand for advanced chips. And simultaneously, a coalition of major customers, maybe Apple, Nvidia, AMD together, strategically decides to shift significant volume to a newly competent competitor. Perhaps Intel, maybe for diversification reasons.
A double whammy.
Exactly. That 1-2 punch could potentially invert TSMC's virtuous cycle into a vicious one. It could collapse their margins, break their near monopoly power, and lead to a permanent re-rating of its valuation. So the question is, what does that kind of scenario reveal about the inherent fragility of even the strongest competitive advantages when faced with both shifting market dynamics and strategic moves by powerful customers?